on December 10, 2008, inside a luxury Manhattan apartment overlooking the city's financial heart, a confession quietly detonated. Bernie Madoff, a man once seen as untouchable on Wall Street, turned to his two sons and said the words that would erase decades of wealth in a single sentence. He told them his investment business was a lie. There were no profits, no strategy, no hidden genius, just the money from new investors paying old ones. By the next morning, the most powerful Ponzi scheme in history was over, and the damage would ripple across the global financial system. Bernard Lawrence Madoff was born in 1938 in Queens, New York. He entered finance at a time when Wall Street still relied heavily on personal relationships rather than algorithms or automated trading. In 1960, with just $5,000, some of it borrowed, Madoff founded Bernard L. Madoff Investment Securities. At first, the business was legitimate. He worked as a market maker, matching buyers and sellers of stocks, earning small spreads on large volumes. Madoff was not an outsider. Over the decades, he became part of the financial establishment itself. His firm helped pioneer electronic trading systems that later shaped modern stock exchanges. In 1990, he became chairman of NASDAQ, one of the most important electronic stock markets in the world. That position granted him immense credibility. To many, Bernie Madoff was not just a trader, he was one of the architects of modern finance. The economic environment amplified his influence. From the 1980s onward, global markets expanded rapidly. Wealth concentrated at the top. Institutional investors, pension funds, endowments, and charities searched for stable returns that could outperform traditional bonds without the volatility of stocks. Hedge funds and private investment partnerships flourished, often operating behind closed doors with limited transparency. In this environment, reputation mattered more than disclosure. And Bernie Madoff's reputation was nearly flawless. Madoff's investment advisory business promised something extremely rare: consistency. While markets surged and crashed, his reported returns barely moved. Year after year, clients saw gains of around 10 to 12%. Not spectacular, not suspiciously high, just steady, predictable growth. He claimed to use a strategy called split strike conversion, which involved buying blue-chip stocks and using options to hedge risk. To most investors, the strategy sounded complex enough to discourage questions, but conservative enough to feel safe. Statements were detailed, showing individual trades, dates, and prices. Everything appeared professional. Access to Madoff was restricted. He did not advertise. He often rejected investors or required introductions from trusted insiders. This exclusivity created demand. Being accepted felt like entering a private financial club reserved for the elite. Wealthy families, celebrities, hedge funds, banks, and charitable foundations competed for space. Feeder funds emerged, entire investment firms whose sole purpose was to collect money from clients and pass it to Madoff. Some European banks offered Madoff exposure to their private clients without fully understanding how the returns were generated. The illusion spread across borders. Behind the curtain, there were no trades. Client funds were deposited into a single account at a major bank. Instead of being invested, the money sat idle. When investors requested withdrawals, they were paid using deposits from newer clients. The reported profits existed only on paper. The system worked because trust replaced verification. A key reason the scheme survived for decades was structural. Madoff combined roles that should have been separate. He acted as investment manager, broker, and custodian of assets. This eliminated independent verification. Account statements came directly from Madoff's firm. There was no external confirmation that assets existed. Audits were conducted by a tiny accounting firm with just a handful of employees, despite overseeing billions of dollars in assets. This alone should have raised alarms, but investors assumed someone else had already checked. Regulators also failed repeatedly. The Securities and Exchange Commission investigated Madoff multiple times between the 1990s and 2000s. Each time, they accepted explanations without performing basic mathematical or market volume analysis. One analyst, Harry Markopoulos, submitted detailed warnings to the SEC starting in 1999. He demonstrated that Madoff's returns were statistically impossible given market conditions. During periods when markets fell sharply, Madoff reported gains. When volatility increased, his returns remained smooth. Markopoulos labeled it the world's largest Ponzi scheme. The warnings were ignored. Madoff's reputation shielded him. Regulators assumed that someone with his status could not be committing fraud on that scale. As financial markets evolved, skepticism grew quietly. Competitors could not replicate Madoff's results. Options traders noticed that the volume of options trades shown on client statements exceeded what actually traded on the exchanges. Some investors asked detailed questions and were dismissed or excluded. Yet the scheme survived because success fed itself. Strong returns attracted new money. New money funded withdrawals. As long as inflows exceeded outflows, the structure remained intact. The real vulnerability was liquidity. Ponzi schemes do not collapse because they are discovered. They collapse because too many people ask for their money at once. That moment arrived in 2008. The global financial crisis triggered panic across markets. Banks failed. Hedge funds collapsed. Investors everywhere rushed to liquidate positions and raise cash. Madoff's clients were no different. Redemption requests surged into the billions. At the same time, new investments slowed dramatically. The math no longer worked. There was no pool of real assets to draw from. The money simply wasn't there. By December 2008, Madoff could not meet withdrawal demands. The illusion of liquidity vanished. Faced with the inevitable, he confessed to his sons, who immediately contacted authorities. Bernie Madoff was arrested on December 11, 2008. Investigators quickly discovered the scale of the deception. Client statements showed approximately $65 billion in account balances. In reality, only about $18 billion represented actual invested principal. The rest was fictional profit. The largest financial fraud in history collapsed in less than 48 hours. In 2009, Madoff pleaded guilty to 11 federal charges, including securities fraud, wire fraud, mail fraud, and money laundering. He was sentenced to 150 years in prison, the maximum possible sentence. His assets were seized, including homes, yachts, and artwork. The damage was global. Charitable foundations shut down overnight. Universities lost endowments. Pension funds suffered permanent losses. Individual investors lost retirement savings accumulated over decades. A court-appointed trustee was tasked with recovering funds. Through asset seizures and lawsuits against feeder funds and financial institutions, billions were eventually returned to victims. However, many losses were irreversible. Financial institutions faced scrutiny for failing to conduct due diligence. Regulators implemented reforms aimed at separating asset custody, improving whistleblower protections, and increasing oversight of private investment firms. The scandal reshaped how risk, transparency, and trust were discussed in finance. There were no true winners. Some investors withdrew money before the collapse, unknowingly receiving funds that belonged to others. Courts later clawed back many of those gains. The real cost was confidence. Trust in financial institutions eroded. The idea that reputation could replace verification was permanently damaged. Madoff's crime was not complexity, it was simplicity disguised by authority. Bernie Madoff did not exploit a loophole in the market. He exploited human behavior, trust in status, fear of missing out, and the desire for steady certainty in an unpredictable world. His empire stood not on innovation or risk-taking, but on silence and belief. And when belief collapsed, the truth surfaced instantly. In finance, The most dangerous number is not volatility, but returns that never seem to change.